The jobs number today, we oftentimes, a little tongue-in-cheek, say it's the most important jobs report since the last jobs report. But it might hold a little bit more water this time around, right? Only because we've priced in this expectation that the Fed could possibly cut rates later on this month.
Yeah, absolutely, Dom. And, you know, the ADP employment report, which always comes out 2 days prior, sometimes it's a harbinger of what the jobs report's going to be, sometimes it's not. But it was disappointing. So, and since the economy is slowing, it's obviously slowing. It wouldn't surprise me to see a slight disappointment today. I think the expectation is right around 170,000 jobs, but we'll see. And as you say, it's the most important number until we get the July report in August.
So I mean, are markets, do they have it correct, Rob? Are we expecting to see the data continue to soften to the point where the Fed is going to cut interest rates this month and perhaps later on this year as well?
I think for a while, Dom, yes, I think we will continue to see some softening of data, but I don't think the data is going to fall off a cliff. You know, I think, but I do think the Fed has got it right. I don't want them to pull the rate cut trigger too quickly, and I think maybe that's one area where I differ with the market, because the market does seem to be expecting a rate cut pretty soon. I'd like to get a little bit more data in personally if I were on the FOMC, but that's, you know, basically the Fed is following the game plan that the market seems to be telling them.
All right, I mean, the argument has been made, and quite forcefully so, that the stock market and bond market have rallied to the levels that they're at right now on the expectation that central bank action will come in to put more liquidity in the markets. So what does that mean? Where is the relative value then? Is it with 10-year U.S. government note yields at 1.97%, or is it with the Dow Jones and S&P at record highs?
Well, Dom, you know, as the Fed has pivoted over the last 6 months from a rate hike stance to a rate cut stance, I think a big part of that has been that the dollar is probably going to weaken somewhat, and I think that's creating some value, to answer your question. You know, I think that that's going to help big cap multinationals, so I would overweight large cap growth stocks versus small cap value stocks. I think for U.S. investors, having an overweight in international investments makes sense. And then finally, of course, if for bond investors, you know, having your bond portfolios be slightly longer than the benchmarks, that probably makes sense here as well.
Rob,
that's where I find revenue.
So this is interesting, because it wasn't that long ago that you were with us saying that you felt as though the U.S. still represented the best value given all of the stuff that's been happening around the world. We were the best house. We were the relative value performers here, and we had the momentum. So why is it now shifted on your end to international being the better bargain versus the U.S. market?
There are a couple of reasons there, Dom. Of course, I mentioned the dollar that could be weakening a little bit. Also, though, too, I think that with the trade war that's going on, unless the talks break off completely, which I don't see happening, I think probably just about the worst has been baked into the equity markets with trade talks. And as I said, I mean, obviously that could, well, and given that, I don't think that we're going to get some grand overriding agreement between the U.S. and China. I think the issues, especially on intellectual property, there's a big gap there. But we're going to at least be able to kick the can down the road, keep talks going. This could go on for quite a while. And I think really the worst has been baked into the stock market from that.
All right, Rob Morgan, thank you so much for those thoughts on the markets this morning. We appreciate it.